Statement of Cash Flows. In November 1987, the accounting profession replaced the Statement of Changes in Financial Position in the Sources and Uses of Funds statement with the Statement of Cash Flows as a required financial statement. This emphasizes the critical nature of cash flows to the firm's operations. It represents cash and cash equivalent items easily convertible to cash within 90 days, and it has an advantage of an accrual method that allows matching of revenues and expenses in a period in which they occur to appropriately measure profits. The new statement emphasizes the critical nature of cash flow to the operations of the firm. There are disadvantages and some things that cash flow analysis helps. The three primary sections of the statement of cash flows are cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. These results added together to compute net change in cash flow. We see a graphic here of the concepts behind the statement of cash flows. Income from operations may be translated from an accrual basis to a cash basis in two ways to obtain cash flow from operations. The direct method, each and every item on the income statement is adjusted for accrual accounting to cash accounting. The indirect method, a less tedious process than the direct method, is usually preferred. Net income is used as a starting point and adjustments are made to convert net income to cash flows from operations, beginning with net income. We would add depreciation for the current period, decreases in individual current assets accounts other than cash, and increases in current liabilities, and subtract increases in current asset accounts other than cash and decreases in current liabilities. Cash flow from investing is found by summing the changes of investment in securities and plant and equipment. Increases are uses of funds and decreases are sources of funds. Cash flows from financing activities is found by summing the sale or retirement of corporate securities and dividends. The sale of securities is a source of funds, and the retirement of securities and payment of dividends are uses of funds. Cash flows from operations, cash flows from investing, and cash flows from financing are combined to arrive at the net cash flows. The net increase or decrease shown in the statement of cash flows will be equal to the change in the cash balance on the balance sheet. Depreciation and funds flow need to be considered. Depreciation is an attempt to allocate an initial asset cost over its life. Depreciation is an accounting entry and does not involve the movement of funds. As indicated in the statement of cash flows, depreciation is added back to net income to arrive at cash flow. Here is an example of an overall statement combining the three sections. The analysis of the overall statement includes how are increases in current assets being financed? Is there associated buildup in current liabilities? How are increases in long-term assets being financed? Preferably adequate long-term financing and profit should exist to finance long-term assets. And short-term funds may carry long-term needs. High-risk situation as short-term sources of funds may dry up while long-term needs continue to demand funding. This PowerPoint slide shows the various types of depreciation as a non-cash expense, a not new source of funds, added back to net income and to determine amount of actual funds on hand, an attempt to allocate the initial cost of asset over useful life, and charging of depreciation does not directly influence fund movement, which is important to remember. Here's a visual of the comparison of accounting and cash flows for your review. Free cash flow is equal to cash flow from operating activities minus capital expenditures required to maintain the productive capacity of the firm minus dividends. The amount of free cash flow is often a determining factor as to whether a leveraged buyout is possible. Certainly there are income tax considerations. Personal taxes at varying rates apply to the earnings of proprietors and partners. Corporate earnings are subject to taxation at two levels, at the corporate level and the personal level when received as dividends. The corporate tax rates have been changed by Congress 4 times since 1980. The after-tax cost of a tax-deductible business expense can be calculated by taking the expense times 1 minus the tax rate. Although depreciation is a non-cash expense, it does affect cash flow by reducing taxes. Tax reduction and cash outflow for taxes resulting from depreciation charges may be computed by multiplying the depreciation expense by the tax rate. See you again in Chapter 3.